Once a titan of the American automotive industry, Ford is struggling to maintain its relevance in the 21st century automotive world, particularly in the realm of electric vehicles. Despite the hype surrounding the F-150 Lightning and the company's aspirations to compete with Tesla, Ford's foray into the electric vehicle (EV) market has been fraught with financial difficulties. In 2021, the company lost nearly $1 billion in electric vehicle sales, followed by an additional $2 billion loss in 2022. The projections for this year are even bleaker, with Ford expected to incur a significant loss of $3 billion this year. These staggering figures highlight the painful consequences of Ford's transition to EVs. However, the company remains undeterred, considering it a necessary cost in its pursuit of penetrating the burgeoning electric vehicle market. Ford's chief financial officer, John Lawler, highlighted that such losses are common during the initial stages as companies invest in capabilities, knowledge development, volume expansion, and market share acquisition. He also reported that despite the anticipated loss in the electric vehicle division, Ford projects profitability in its other segments. Ford Blue, representing traditional cars, is expected to generate a pre-tax income of $7 billion in the current year, surpassing the $6.8 billion recorded in 2022. Similarly, the commercial vehicle division, Ford Pro, is projected to achieve a pre-tax income of $6 billion, almost double the $3.2 billion reported in 2022. The significant losses incurred by Ford in the field of electric vehicles have raised concerns regarding Jim Farley's leadership and the overall future of the company. While Jim Farley remains positive about Ford's prospects and aims to surpass Tesla, the current situation does not bode well for the automotive giant. But the question arises why a powerful and competitive automobile company like Ford is not able to generate profit in the electric field market. Well, Ford's struggles can be attributed to a multitude of factors, with declining sales being a primary concern. The high costs associated with developing and manufacturing electric vehicles present a significant challenge for the company. It is reported that in the first quarter of 2023, the company faced a significant loss of $700 million before interest and taxes for this division, indicating a worrisome financial situation. Shockingly, the earnings before interest and taxes (EBIT) margin for the Model E division stood at negative 102.1%. which was over twice the already troubling negative 40.4% margin recorded in the fourth quarter of 2022. This negative margin signifies that the costs of production and operation for Ford's electric vehicles far exceeded the revenue generated during the first quarter. Digging deeper into the numbers, it became evident that the situation was exacerbated by the low number of electric vehicles delivered by Ford. In the first quarter, Ford managed to deliver only 12,000 electric vehicles, which is significantly lower than the company's expectations and market demand. This disappointing figure raises concerns about the company's ability to meet the growing demand for electric vehicles and compete effectively in this rapidly evolving market. After analyzing the financial implications of these results, it's apparent that Ford faced a staggering loss of approximately $58,333 per clean car sold during the first quarter. This figure underscores the financial strain experienced by the Model E division and highlights the urgent need for corrective measures to improve the division's profitability and operational efficiency. Moreover, the company's challenges are further compounded by questionable practices observed at its dealerships, which have led to a deteriorating customer experience and tarnished Ford's once reliable reputation. Disturbing reports have emerged exposing dealers who unabashedly charged customers exorbitant markups on EVs. These practices not only discourage potential buyers from considering Ford's electric offerings, but also cast a negative light on the brand as a whole. Such unfair and exploitative practices undermine Ford's commitment to affordability and accessibility in the EV market, leaving customers disillusioned and disheartened. Adding fuel to Ford's already raging fire were the skyrocketing interest rates implemented by the Federal Reserve to control inflation. These record-high interest rates translated into more expensive financing options for both new and used vehicles. Ford, already struggling to maintain profitability and regain consumer trust, found itself grappling with the burden of expensive financing, further denting its chances of recovery. In an attempt to compete with industry leader Tesla, Ford has resorted to reducing prices on its all-electrical Mustang Mach-E. Not once, but twice this year, and recently announced its decision to enter into a partnership with LG Energy Solution to establish a state-of-the-art battery plant in Turkey. In doing so, Ford has chosen to discontinue its collaboration with SK On, which is a renowned and influential player in the field of electric vehicle battery manufacturers. As per reports, Ford and LG Energy Solutions, LGES, have signed a non-binding Memorandum of Understanding to develop one of the largest commercial electric vehicle battery cell production facilities in Europe. The planned project is scheduled to commence near Ankara, Turkey, later this year and aims to commence battery production by 2026. Ford's ambitious goal is to provide support for 2 million electric vehicles worldwide by that target year. The upcoming facility will boast an annual production capacity of a minimum of 25 gigawatt hours GWH, with a potential increase of 45 GWH for battery cells. However, it is important to note that the deal is contingent upon the final agreement by all participating parties. This strategic move aims to make electric vehicles more accessible to a wider consumer base. Moreover, Ford aims to manufacture 600,000 electric vehicles by the end of this year. The company plans to produce a staggering 2 million electric vehicles annually by late 2026. While these targets are ambitious, they still fall short of their main competitor, Tesla, who is commanding around 2/3 of the US electric car market and produced 1.4 million EVs in 2022. It seems like Ford needs to analyze the strategies Tesla is accompanying to maintain its position as a frontrunner in the automotive industry. Demonstrating its impressive growth, Tesla's net profit in the second quarter of 2022 alone was 3 times that of Ford's. This remarkable achievement can be attributed not only to Tesla's groundbreaking electric vehicles, but also to its unique direct-to-customer sales model and strategic price adjustments. By bypassing traditional dealership networks, Tesla has established a direct connection with its customers, allowing for a more personalized and streamlined buying experience. This approach has enabled Tesla to forge strong customer relationships, gather valuable feedback, and swiftly adapt to evolving market demands. Moreover, Tesla's ability to strategically adjust its prices has further bolstered its competitive advantage. By carefully analyzing market trends and consumer preferences, Tesla has demonstrated a keen understanding of pricing dynamics. The company has adeptly utilized pricing strategies to maximize its market share, optimize profitability, and stay ahead of its rivals. This agility in pricing has not only attracted customers, but also deterred competitors from matching Tesla's offerings, thereby solidifying the company's position as an industry leader. For example, Ford faced a blow when Tesla strategically slashed prices for its Model 3 by 4%. In an attempt to catch up, Ford cut the prices of its Mustang's Mach-E up to $5,900. Amidst these mounting challenges, Ford has chosen to take a bold and decisive step toward redemption. Recognizing the need for change, Ford has devised a direct-to-customer strategy in Europe, signaling a significant shift in its approach. The company plans to drastically reduce the number of dealerships and implement tighter price regulations. This strategic move aligns with the rising trend of online car purchasing, popularized by Tesla, Ford hopes that this new direction will serve as its saving grace, breathing new life into operations and revitalizing its brand. Moreover, Ford has decided to split its business, signaling a fundamental change in its operational structure. By dividing their business, Ford aims to play both the electric vehicle game and the gas-guzzling game, effectively hedging their bets and attempting to outwit competitors like Tesla. This move demonstrates Ford's commitment to adapt to the evolving market and capitalize on the growing demand for EVs without neglecting its traditional customer base. The company's long-term strategy appears to involve transitioning from internal combustion engine vehicles to EVs by leveraging its Model E unit. Some industry experts suggest that once Ford's EV division becomes profitable, the company may eventually declare bankruptcy. This strategy would allow Ford to gradually phase out internal combustion engine (ICE) vehicles while relying on the profits from this unit to support the development and growth of its electric offerings. Ford's journey toward profitability in the EV market is undeniably challenging. The company's financial losses, dealership issues, and stiff competition from Tesla have cast a shadow over its future. However, Ford's ambitious investments and strategic initiatives demonstrate its determination to navigate the EV landscape successfully. Whether Ford can outpace Tesla and overcome its current obstacles remains uncertain. The automotive giant must make prudent decisions, collaborate closely with dealers, and deliver reliable and appealing vehicles to regain its footing in the evolving automotive industry. The road ahead is challenging, but the final destination for Ford is yet to be determined. This brings us to the end of our video. Please like and subscribe for more updates in the technology industry.